Hello, I am Vishal Prabhukhanolkar. Let us talk about capital markets. First of all, let us understand what is a market. Market is a place where a particular commodity or product or service can be traded. Somebody produces that good/service and somebody else, the other entity which is participating in the market, consumes that good or buys that good. So what do we mean by capital market? Capital market is a market where capital is created. By capital, we mean money, and not only money, but specifically money in long term. So whenever a company or government wants to create a long term capital, they use a market called capital market. Now long term has many meanings, but here in context of capital markets, by long term we mean more than a year. So any generation of money using securities or debt, securities in the form of debt or equity for more than 1 year is done using capital markets. Now capital markets are of two types. One, debt market, the other, stock market. Debt market basically deals with mortgages, securities and other debt instruments and their trading. Stock market, however, deals with trading of common equity. So how do companies or governments create money in, say, stock market? So basically every investor gets a share and those shares are traded. Depending on the popular perception about a company or the government's performance, the share is traded at a higher or lower value. This higher or lower value reflects the amount of money that the company or the government gets. Generally, any company or any government participating in stock market is there for long term. The stocks will not be liquidated in short term. So the money is generated and the money is available for more than a year. Now there is a concept of real value versus notional value. For example, let us say you have bought a stock at 10 rupee face value and now the stock is trading as 100 rupees face value, 100 rupees value. What is the value? What is the notional value here? The notional value is rupees 100. Unless you liquidate that stock, in the sense that you sell that stock, you will never get those 100 rupees. Those 100 rupees are the notional value associated with that stock. On the other hand, the actual value of the stock in your context is still rupees 10. Also note that whenever this sale happens, either in the stock market or the debt market, it happens through a process called underwriting. Now both these markets, debt market as well as the stock market, can be further classified as primary market or secondary market. Primary market is the one where the base stock is directly traded or the base debt instrument is directly traded. On the other hand, secondary markets, the instruments are derived from the base stock. So the base stock is not directly traded, but the trade itself is traded. That is called a secondary market. Since capital markets deal with a lot of money and for a longer period of time, a high amount of regulation is placed over all these markets. May it be debt market or may it be stock market. Every country has a regulatory authority which is present for controlling both these markets, especially the stock market. For example, in India we have SEBI, in UK we have FSA, Financial Securities Authority, whereas in US we have SEC, Security and Exchange Commission. So these three are the regulatory bodies. So similarly, every country has a different regulatory body for regulating the transactions which are happening in these markets. What are the primary functions of these regulatory authorities? First, check that all the transactions which are happening are fair. We are familiar with what happened in Harshad Mehta case, or Ketan Parekh case for that matter. These are the cases which the regulatory authority tries to avoid. So more and more regulations and innovations are added in financial markets, in capital markets especially, to avoid and to curtail these kind of behaviors. That is the role of financial regulatory bodies.